Brenda, I'm moving to Dallas. I'm planning to buy, and for those of you guys who are entrepreneurs, you know how we do, right? We write everything off so we can pay the least in taxes. And I said, Brenda, I can't write everything off this year because I need to have some income so I can make a home purchase. And Ms. Brenda shared some information with me. And when she shared that with me, I said, this is a no-brainer. And yeah, tell me more. So I'm excited tonight that I have, first, we're going to hear from Mr. Clardy Richardson, who is really, I just have to say this, he's just a man of integrity. He is just passionate about really serving people. And what I love about, just a little bit about who he is. So Clardy, Mr. Richardson has been in the crypto space since 2017, serial entrepreneur, real estate investor, and he's actually been helping more and more families with this strategy that we're going to share with you tonight. And so I want to turn it over to Mr. Clardy Richardson so that you guys can get this information just straight from the horse's mouth and, really be able to add this to your knowledge base. So Mr. Clardy Richardson, are you ready? Are you available?
I am. Can you guys hear me okay?
We can hear you loud and clear.
Outstanding. Well, Ms. Plunkett, thank you so much. Thank you, BB Hills, for allowing me to participate with you all into something that is very dear to my heart as far as when it comes to education and helping people find about things that they may not have known about or no one have shared with them. And the fact that I'm 57 years old and I've only known about this for the last 3 years says a lot, to me, because it's like, man, what if I had known this information that I'm going to share with you all here a lot sooner? So it's a pleasure to work with you, Jackie, and your husband, Jason, just to be able to actually bring some more people into the fold, because we got a lot of work to do. We have a lot of people that we want to help. And I had the pleasure of finding out about this specialized trust about 3 years ago. And in that process, it was my first time ever hearing about it. And then coming from a serial entrepreneur status, we always are concerned about the tax situation. It's almost like you want to make as much money as you can, but you're always trying to keep Uncle Sam out your pocket, trying to minimize how much we have to give to them and keep it above board, right? So it's that juggling act of being able to make as much as we can, but pay as less as we can when it comes to taxes has always been a part of my entrepreneurial journey. And always been that cross around my neck, I should say, wanting to be able to navigate the waters when it comes to taxes. So when I heard about this, it was really exciting about me. And so I want to say this real quick. I want to just talk about, and if you see here, it says attention.
Recording in progress.
Successful business owners and investors that are facing large tax burdens. Well-known tax strategists for high net worth and highly taxed individuals is revealing proven strategies to shockingly reduce your tax bill. Within a single free phone call, you'll learn the strategies that your current CPA is not even aware of. I guarantee you, they probably don't even know about it. And we do this without hiring more employees, the different strategies that people do, giving your money away to charity so you can write it off, or raising unwanted red flags because we're trying to take off all of these deductions to keep you from paying so much in taxes. Ladies and gentlemen, there is a wealth of knowledge in the world, but very little knowledge about wealth. Why is that? Why are they not teaching us, financial strategies and teaching how to grow a business and how to be successful as entrepreneurs? And why are they not teaching us these things in school, right? There are roughly, and hear me when I say this, think about this. There are roughly over 70,000 pages in the United States tax code, 70,000, but only about 30 pages of those 70,000 pages are dedicated to actually paying taxes. The other 69,970 plus pages show you exactly what you must do to lower your dealing with the tax code to avoid paying taxes. Which side of the wealth gap are you on? Are you dealing with the creative tax code? Are you on the side that where your tax advisors are on? Matter of fact, are your tax advisors, are they on the same side that you're on? What we want to do is just educate you and get you to understand that we have technically are playing the same game, but somehow wealth individuals are playing with a different set of rules. Matter of fact, Jackie, she had a video that we were trying to show, and it was where when Donald Trump was having a conversation with Hillary Clinton when they was running for presidency, and he turned to her and said that she had been in the Senate for many years, long enough that if she didn't like what he was using as far as using the loopholes and the tax codes and the rules of taxing, the IRS, if they didn't like what he was doing, she's been in power long enough that she could have changed the rules. But he said that she's not going to do it because all of them are doing it, right? The wealthy are the ones who are not paying the taxes. And until you make the leap from using an accountant to going to a tax strategist like Miss BB Hill, who you'll find out and hear from her a little bit later, that's when you'll start noticing a difference. Because at the end of the day, you're not just looking for someone that just wants to add up and bring in new ideas and tax strategies with your accountant, and then they just add and subtract. You are looking for someone that's going to give you some strategies. And so that's what we're here to do, is to do just that. We want to give you some strategies. And with that, ladies and gentlemen, I want to introduce to some and present to others none other than what we call, this is the tool that you need to really change your life. And it's been life changing for me. A non-grantor, irrevocable, discretionary, complex spendthrift trust. Can you guys still see my screen? Okay. Just want to make sure. Can you still see my screen?
Yes.
Okay, the non-grantor. Okay, perfect. So we're talking about a non-grantor, irrevocable, discretionary, complex spendthrift trust, which is designed specifically for both asset protection and tax reduction. The secret to success is to own nothing but control everything.
Marty, really quick, I think are you onto the slides now?
Yes, I am.
Okay, we're back. We're seeing the previous.
Okay, so that's what I was curious on, because I did go to a different, okay, hold on.
Maybe stop sharing. Okay, perfect.
Okay, how about now?
Perfect, we can see it.
Okay. So as I was saying, we want to introduce you to a non-grantor, irrevocable, discretionary, complex spendthrift trust, which is designed specifically for both asset protection and tax reduction. The secret to success is to own nothing but control everything. And that's what Nelson Rockefeller has stated. What I want to share with you is what the dictionary, the Black's Law Dictionary, is defining as a trust, which is an equitable or beneficial right or title to land or other property held by one party for the benefit of another. The trustees hold the legal and the equitable title to the property for the benefit of the beneficiaries. And let me explain with you what that's all about and how that works, because at the end of the day, we don't want to become a statistic. Currently, the U.S. has over 91,000, think about this, 91,000 personal injury lawyers. Most of them work on contingency. Their fees are between 30 to 40% of whatever you're awarded, right? And according to the IFG services, Americans have over 33% chance of getting sued. And according to AMA, 63% of all surgeons get sued. Over 20 million civil cases are filed every year in the US, and the average business lawsuit costs about $72,500. So no matter the type of property or the injury involved, property owners are liable for all injuries incurred due to hazards associated with their property, whether at home or a business. Slips and falls annually are the #1 most common personal injury lawsuit, and about 25,000 people a day are filing lawsuits. Everybody's a victim of a slip or a fall. And since the 80s, personal injuries have increased by over 30%. What happens when a business or individual does not have enough insurance coverage? A lawsuit can tap into your business and or your personal assets. It can pierce the corporate veil, whether it's a C Corp, S Corp, LLC. If the assets are protected in the trust, the claimant can only recover the amount of the insurance policy. You have people that are winning dog bite lawsuits of millions of dollars and car accidents for millions of dollars, and you're worried about just your tax side of it. But what about protecting your assets? What about protecting your wealth? Because, if you look at some of the court cases, the Supreme Court case, Elliott versus Freeman, ruled that a spendthrift trust organization is not subject to legislative control. I'm going to say that one more time. Supreme Court case, Elliott versus Freeman, US 178, ruled that a spendthrift trust organization is not subject to legislative control because trusts are contracts. They are not subject to the myriad of strangulating legislature controls. That is so important. You'll understand how important that is soon. The ultimate in asset protection is what we're talking about. This trust is not subject to tax liens, ladies and gentlemen. It's not subject to levies issued against beneficiaries or the trustees, divorce, alimony, child support, creditors, governmental agencies, or third-party claims. This trust is not subject to eminent domain when it comes to real estate, and they're saying that they got to take part of your property because of the better good of the community. You've heard eminent domain. It is not subject to court's jurisdiction or turnover orders except for fraudulent conveyance. That's the only way that you would have an issue if you fraudulently conveyed your properties over to a trust while you're in a lawsuit. Property and assets held by a properly constructed spendthrift trust cannot be seized. Further, the trustees and the beneficiaries are not liable for the debts of the trust organization. Ladies and gentlemen, no seizures of assets, no foreclosures, none of that. You put it in a trust, right? We utilize a one-of-a-kind registered copyrighted spendthrift trust, which defers taxes legally per the IRC, the Internal Revenue Code. The trust document is written to defer and minimize income and estate taxes to the fullest extent that the IRC allows. Zero gray area. So, sometimes people are like, oh, is this legal? Can you do this? There are zero gray areas when it comes to this. Zero capital gains until distribution. Simplify the accounting process, because when you look at the way that these trusts, when it comes to the tax portion of it, which I believe this for Ms. Brenda Hill, but you're talking about simplifying the accounting process. It's amazing. The trust does not conceal or misrepresent. All income and expenses are shown and tied 100% to the following tax returns. From business income tax return, your trust income tax returns, your personal income tax return. None of the thousands of returns that have been prepared by our accountants have ever been flagged for an examination. Think about that. Out of all the years they've been doing this, none of them have been flagged for an examination. And what you'll love about this the most is that you're allowed to keep, or I say allow, but you are able to keep your trusted advisors. Maintain all your relationships with your current advisors, your lawyers, your CPAs, money managers, agents, financial advisors. We don't interrupt your business as a consultant. We only need to view your tax returns to get started with an asset protection and tax reduction strategy. Keep sending virtually the same way with minor changes. We keep spending them, with virtually the same way with minor changes. And we teach you how to expense versus using taxable distribution. Money managers tend to like us because we actually give them more money to manage. We will do your taxes. You can let the other people, your CPAs, do your bookkeeping. So when it comes to your trust taxes. So we talk about the uninformed versus the informed. The uninformed, no matter what wealth class, because we got the wealthy uninformed and the not so wealthy uninformed, right? All wealth classes pay more taxes. The uninformed are vulnerable to claims of liability. The informed, ladies and gentlemen, pay less taxes. Matter of fact, that's something else that I'm not a Donald Trump fan by no means, but he did say, that, and he said it arrogantly that, you all can be mad at me, but it just means that my tax and accountants and legal counseling know more than your people, than you all do. I mean, he just said it like that. It was kind of like, wow, he just slapped you in the face. Hey, my people know more than your people do. So the informed pay less taxes, avoid federal and state probate, are protected from claims and liability, and enjoy complete privacy. That's what this is about, ladies and gentlemen, privacy. Tax avoidance is legal. Tax evasion is illegal. Because you always say, well, why did they go to jail? Were they trying to evade or avoid? It goes because they were trying to evade. Tax avoidance, according to the IRS handbook, the Department of the Treasury IRS handbook for special agents 412, tax avoidance is not a criminal offense. So, ladies and gentlemen, you can legally avoid paying taxes. Any attempt to reduce, minimize, or alleviate taxes by legitimate means is permissible. Here are some cases again. Edison, California Stores versus McCogan ruled that persons may adopt any lawful means for the lessening of the burden of income taxes. In Weeks versus Sibley, it talks about with Edward versus with the commissioner, the courts ruled that a spendthrift trust organization is not illegal, even if formed for the express purpose of reducing or deferring taxes. It does a whole lot more, but even if you just formed it for that, it's legal to do that. Tax evasion, ladies and gentlemen, is illegal. Intentional omitting something, improper deducting, false allocations, taking off that write off, we do, and you know what I'm talking about. Improper credits or exemptions, concealment of assets, that, ladies and gentlemen, is all illegal, and that's not what we're doing here. Trusts are legal entities. It empowers the trustees of the trust to have and to hold all control over property and assets, including the transfer and management of properties, cash, and other assets. That's right, ladies and gentlemen, the trust empowers the trustees of the trust to have and hold all control over the property and the assets. The history of our trust, formed from registered copyrights granted back in 1999, has some amendments in 2012 and 17. These trust formats have been in use for over 18 years, and actually longer. Over 30,000 of our trusts are currently in existence, designed by a collaboration of tax attorneys, CPAs, trust attorneys, contract attorneys. It took over 12 years to perfect this copyrighted document. It's a copyright. Payment of taxes is deferred until sometime in the future when the trust assets are distributed. These trusts were written for the primary purpose of both asset protection and tax reduction. It meets with, as far as with compliance with the Scots on trust laws, Uniform Trust Code, Restatement Third of Trust, Internal Revenue Code. It conforms with all the contract trust and tax laws in all 50 states. So you don't have to worry about, well, can I do this in Oklahoma? Yes, you can. Can you do it in Maryland? Yes, you can. Can you do it in Alaska? Yes, you can. How about Hawaii? You sure can. That's right. You can do it in Hawaii, ladies and gentlemen. What makes our trust unique? The registered copyright is based on a combination of 5 unique components that cannot easily be duplicated. Number 1 is irrevocable. We'll talk about that. Number 2, it's a non-grantor. Big deal, huge difference in what most people get, non-grantor and grantor. It has a dual track, complex and simple provisions. It's discretionary. It has a spendthrift provision. You have complete control as a trustee who manages the assets, makes investments, and banking decisions. Compliance overseer, which is you or can be you, adds and removes trustees and beneficiaries. Irrevocable simply means that the terms of the trust agreement cannot be modified, amended, or revoked. Assets transferred to trust may never revert to the one who is making the endowment, which could be the settler. separates the settlor from the corpus of the trust. And you'll learn about the difference between a settlor and a grantor and non-grantor. You'll learn about all that. We'll teach you about all that, especially in our National Trust Institute, which you'll hear about here shortly. Non-grantor versus grantor. Non-grantor exempts the trust from any alter ego status that brings into action the management or the beneficial enjoyment by the settlor. It's a non-grantor's trust. A grantor's trust is a creator of the trust who generally has management of the corpus or is a beneficiary of the trust. Most grantors' trusts are called living trusts, which have limited benefits, no asset protection, and no tax advantages. Our trust is a non-grantor trust, not a grantor's trust. Again, the dual complex with simple provisions. Complex trust can accumulate income and distribute it from the corpus. Simple trust must distribute income currently and cannot accumulate income, cannot make. So we have different differences that this trust can do. It becomes a complex trust for that year. Therefore, this trust alternates between simple or complex, and you'll learn more about that. I'm not trying to teach a tax strategy here, but just kind of telling you what all is involved. It's discretionary. Ensures the absolute and sole discretionary power of the trustee in determining the distribution of income and or principal to the corpus and or the beneficiaries of the trust. There is no requirement to distribute income. There's no requirement to do that. You can, but there's no requirement to do it. If any single percent of the corpus is designated to be held or distributed to any one or more beneficiaries, the discretionary designation of the trust would be invalid. Therefore, no beneficiary has any rights to any percentage of the corpus of the trust, and we'll teach you what that means and how you do that and how you operate in that, in using the trust and being able to be the blessing to your kids and your family. So the critical element of the document, which is the spendthrift provision, is that no spendthrift trust corpus may be penetrated to reach the assets of the corpus of the trust, the assets of the trust. No judge or court may issue a turnover order against a properly constructed spendthrift trust, with one exception. Again, ladies and gentlemen, that's the fraudulent conveyance, which is the illegal transfer of property to another party in order to defer, hinder, or defraud creditors, or to put such property out of reach of a creditor. You must have a trust in place before any lawsuit is officially filed to be protected, right? So you don't want to wait. You want to get it as soon as you can. Spendthrift trusts are designed for the sole benefit of the beneficiary. Expenses to maintain trust assets that are used by the beneficiaries and paid directly from the trust bank account are considered trust expenses and are not taxable to the beneficiary. Pre-tax income distributed directly to a beneficiary is a taxable distribution to the beneficiary. And we'll talk again, giving you examples, like a taxable distribution would be if you wrote a check to a beneficiary and had them pay for their school, that would be a taxable event. But if you wrote the check from the trust to the school, then it would not be a taxable event. Or if you purchased a car with trust funds and the beneficiary was allowed to drive it as needed, as opposed to giving the beneficiary the cash to buy the car, which would be a taxable distribution. So it's all about just changing up just kind of how you do things, but still get the job done, right? IRS code rule 643 states that the trustee has sole and absolute authority to designate income as an extraordinary dividend or taxable stock dividends, and that it is paid to the corpus of the trust and not subject to distribution. It is not income to the trust according to Rule 643. Well, what does that mean, Claudia? Well, just to kind of give you an idea, if you look at the business net income of 1.2 million, the current scenario without a trust would be that the taxable income of 1.2 million, estimated at 37% tax rate, you're looking at 444,000 taxes that are due. Zero asset protection. That's what most people are doing that makes that type of money. Or with a trust scenario, you sold the business assets to the trust, which provides total asset protection at that point. Your business leases the asset from the trust for $1 million. The business net income is $200,000, estimated 20% tax rate, $40,000 tax code, which is a $404,000 tax reduction with the trust strategy. Ladies and gentlemen, if you had a choice of paying $404,000 444,000 or 40,000, which would you want to do? It's pretty obvious. It's pretty obvious which one makes more sense. And with that being said, there's a lot here that we can unpack. We're not going to keep you long. And what I want to do at this time, because I know there's some questions out here, but and there's going to be more. We'll sit down and do individual calls, but this is just to kind of let you know and kind of give you some information. I'll let you know that it's legal, basically, that we give you some references that you can look up and see that what we're talking about is being done, and it's not something that we're doing under the table, because number one, it's been copyrighted. Who would copyright something illegal, right? The law firm that put this whole thing together, who owns the copyright, they have designed this and put it together in a way that it's a win-win for all of us. So what I'm about to do now is introduce a person who handles the tax side of it. This person, when we talk about having an accountant or having a tax specialist or a tax strategist, a person who understands the all 7,000 of those pages of the IRS code, this is the person who I have the pleasure of introducing you to. She is a enrolled agent, meaning that an IRS enrolled agent, meaning that she understands a higher understanding of the IRS code and understands how to operate within the trust using the IRS code and keeping us in compliance. This young lady runs a successful accounting firm, and she has offices in Shreveport as well as here in Dallas, and thriving hundreds of thousands of customers from all walks of life, corporate, very successful financially, all the way down to W-2 people who are just trying to make ends meet. She covers all bases. She does not discriminate. Her office is open. She has an incredible team. She loves the Lord. And guys, I tell you, you're talking about a beautiful spirit, but a sharp when it comes to understanding this stuff. I saw her doing we had a debate, not a debate, but a discussion with one of the other trust strategists, a legal team, and they were trying to figure out a solution for a client. And when Ms. Hill came in, she just gave him the scenario, and the guy just only thing he could say was, "That's brilliant. That's it. You can do that." I mean, it was just no questions asked. That's what it is. And so I'm pleasured, and I'm excited to say that she does my taxes, thank God, right? And she knows I've recommended and referred, several people to her to help with their financial situations and taxes, all that stuff. Incredible woman of God. I'm excited to call her my friend, my business partner. I want to introduce to some and present to others, none other than Ms. BB Hill. Are you out there? I think you got to unmute yourself. Ms. Hill.
Okay.
I hear you. There you go. Say it again.
Can you hear me?
I can hear you. I can hear you.
All righty then. Thank you so very much, Clardy. I'm super excited to be here, and I want to thank you and Jackie for having me on. Thank you for inviting me to come on with you to help get people informed.
Right.
The uninformed and the informed. I love it. I love it. I love it. I'm so grateful to God that I'm part of the informed. I tell you, when I was growing up, one of the things that I often wondered when I was going to school with some girls, what does it mean they are called trust fund babies? What does that mean? What does that mean? I never knew till several years ago really what a trust fund baby meant. I knew I wanted to be one. I knew that they had more than what I had. I knew that they drove the best cars and wore the best clothes and did all of the great things growing up in high school and in college. And I just didn't understand what made them different than me. Again, they family were informed. They knew something that my family at that time did not know. So I'm glad and happy to announce that I never made it to be a trust fund baby, but right now I am the trustee of a couple of trust fund babies, guys, and it has worked tremendously for me. Not only am I the trustee of a couple of trust fund babies, I am one that prepares the taxes for a trust that I oversee as a trustee. That's right, you heard it. I prepare the taxes for a trust that I am the trustee of. Now, notice you didn't hear me say that I own a trust. I say I am the trustee of a trust. I've learned what Rockefeller meant when he says the key to wealth is controlling everything, but owning nothing. So I've learned how to operate and to do that. And what I like is I'm teaching most of my clients, those that are not informed, of how they can do that as well and how it's legal. Clardy mentioned earlier that he's not a big fan of Donald Trump, but I would like to say I am Trump's number one fan. You heard it, number one. I love exactly how Trump was living. So he learned to live. That's right, Kathy. He learned to live in a way that the informed lived in. He learned to take those rules that IRS made, and he learned how to apply those rules to his everyday life to make his living better. He learned how to just operate and flow in the function of the trust. So I'm his number one fan. And I remember when I used to watch the show that he had, when he was talking about the trust and talking about operating, didn't understand it then, didn't have a full knowledge of it, but just becoming an accountant and putting all that together and say, wow, it was just wow moments. This is what he meant. This is what he meant. This is what he meant. But this Spendthrift Trust, guys, I'm happy you're on this call. I'm happy you're getting this information. With all that being said, I'm so grateful to God that whomever invited you to this call, I want you to hang up when you get off this call, I want you to call and thank them, because there is no better place to be in. This Spendthrift Trust, I've done taxes for 7-figure earners, 8-figure earners, 9-figure earners. And just as Clardy just stated earlier, those individuals that are earning this much, those amounts in their businesses, are paying less than some of my W-2 earners that are making less than 6 figures. Not because they're better, but because of the information that they have. My Bible says my people are destroyed because of lack of knowledge. And I would like to say it's the lack of knowledge that we don't have that destroys us. But you're in the right place at the right time, getting the right knowledge from the right people who want to inform you of how you can learn to avoid taxes. Again, if you heard him earlier, avoiding taxes, there is no law against it. There is no law against avoiding taxes. And this Spendthrift Trust is just one of the ways that you can learn to avoid taxes. It's legal. It allows you to defer taxes. It's much like the 401k. We all know about the 401k. We've all heard about the 401k. We've all probably participated in the 401k. Well, if you didn't know that, the 401k is a trust. That's right, complex trust. It allows you to place money inside of the corpus of that trust, which merely means the body of that trust. And as long as you place the money inside of the body of that trust, and that money is intended to make you more money, you can defer taxes on it. You do not pay taxes on it, on those monies set aside, until you make a distribution. Same scenario, same comparison. Being the trustee of this type of trust, you can place money in the corpus of the trust. You will not have to pay taxes on that money as long as it's in the trust until a distribution is made. But what we will be doing at National Trust Institute is teaching you how to operate and flow in the corpus of the trust, how to use the money and not make distributions on the money. Those some of the things that Clardy mentioned earlier. So we can go on and on all night long. I don't want to hold you long, but I did want to stop by and say, listen, take heed, hear what they're saying, study the information, call, set appointments, ask questions, get your personal questions asked, but hearing it from a tax accountant, hear it from myself. I've been preparing several of these taxes for several years. And just as Clardy stated, not one of them, guys, not one of them have received not one note from IRS. Why? Because we're operating and we're flowing inside of the rules that they created. And not only are we doing that, we're telling them about every dime, every nickel, every penny. I don't care if it's 10 figures that we're making. We're not hiding anything. Not only are we telling them about all the income, all of the revenue, all of the capital gains, we're not coming up with expenses that we actually did not have to try to lower our tax bill. We're letting them know we're holding all that money in corpus, and we're saying we're not going to pay taxes on it because we're choosing, making a discretionary decision as a trustee to defer the taxes. And it's all legal. And it's all legal. So I won't hold you. I just wanted to hop on and just share my little tidbit. And I want to thank Scotty and Jackie for having me to hop on. But I do want to say welcome to the Informed Club. Welcome to the Elite Club. Welcome to the Secret Society, as Jackie has said, as joking. This is the right place to be at the right time. You can lower your tax bill, protect your assets, and also have trust fund babies. So again, thank you guys for having me. If we have any questions, I'm sure Jackie and Claudia is setting up times and private calls, but I want to thank you guys again for having me on tonight. God
Brenda,
bless.
really quick, do you mind if we just ask maybe just a couple of a couple commonly asked questions? Because I know people are on here, but there's just a couple of questions that we just kind of wanted to ask you, if you wouldn't mind
Sure.
answering.
Sure.
So,
Okay.
so,
Go ahead, Claudia.
yeah, go ahead. Do you have one particular you want to ask first, Jackie?
I do have one, which
Okay.
was a really good one. So what happens, and this was a good one, and Jason had asked this one, what happens to the built up tax balance? Should I defer all taxes? Will my beneficiaries be protected? Do they need to create their own spendthrift trust to defer those taxes? If not, how can I prevent the deferred taxes from being put onto them in the event I pass away before paying the taxes?
Awesome. So that is a great question. Many people have that question. So let's talk about it. So let's say we made $5 million this year, and we made a discretionary decision, or the business that the trust owns personally, we made $5 million and we allocated that $5 million to the corpus of the trust. What happens there is, as a tax accountant, we would do what's called an extraordinary dividends declaration of that $5 million to the corpus of the trust. And even though normally, as Claudia just stated, we may know what the tax bill is by if that income was taxable, the bill would be, let's say, $700,000. Although we know what the bill would be, we remove that $5 million from taxable income to non-taxable income for the sake of the trustee making a declaration of that money's being held in the corpus of the trust. So I'm explaining it in detail such as that because there is no build up of a bill. When that return is transferred to IRS, it shows a zero balance due on that $5 million for that year, merely because we are stating that that $5 million is held in the corpus of the trust and it's deferred for later dates if a disbursement is made. So we're reporting it. There is no amount due on it. It actually shows zero, and that $5 million is actually held. So if, per se, something happens to you and the compliance overseer names a new trustee, and the beneficiaries do not have to worry about previous monies that was held in the corpus of the trust, because that money is still held. That money could have been used for legal expenses of the beneficiaries throughout the years or throughout the following year. The important thing is to maintain good accounting records for that $5 million to say how it was used, because there's legal ways that we can use money that's held in the corpus of the trust as an expense rather than it being a distribution. So just because you ended up with $5 million last year, next year you could have $3 million because you used it to either pay for expenses of the beneficiaries, maybe buying a house, maybe for the beneficiary, maybe paying for education for the beneficiary, maybe paying for a car. So that money that you use to allocate to expenses for the beneficiaries is coming out of the money that was held in corpus. So there is still a non-taxable event. So that money that was held in corpus is still going down if you're not reinvesting it, of course. But again, there is no tax bill being built up. There is nothing that you're leaving for your beneficiaries for a later date. What we really like to teach the trustees to do is, much like 401k, I keep going back to that because that's something we're familiar with. Once you allocate money to the corpus of the trust, find ways to use it legally and not distribute it. And as long as a distribution is not made, it's not a taxable event. So let's say I have money held in corpus, $5 million. I want to use it, but I don't want to use it for an expense. Much like 401k, I can go and to grab that money by doing a loan. So now I can borrow against money that's sitting in the corpus of the trust. It's still not a distribution. It's still not a taxable event. So there's still no taxes due. So the ideal is to learn ways in which to use the money legally as an expense and not a distribution. To learn ways to get money out of the corpus of the trust and not make it a taxable event. So to answer your question, Jackie, if educated properly, if you become informed of ways to use the money correctly, then you should never be building up a tax bill. Your beneficiary should never have a tax bill. Deferments every year don't create tax bills.
So Brenda, I just want you to know, you're probably not seeing, but there's like light bulbs going on in the chat because it's like the ding, ding, ding. So is this equivalent to when I remember seeing a few years ago, Jeff Bezos paid zero in taxes on $11 billion?
Absolutely.
That's so this is essentially what he did.
This is essentially exactly what he did and probably is currently doing. Many of our officials are doing the same thing. Absolutely. 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 And we never have any tax troubles because why? We're not hiding anything from the government. We're being truthful. We're operating. We're saying, hey, listen, this business that's owned by the trust made $10 million this year. We're reporting everything. We're hiding nothing. So we found a legal way to reduce taxes. So we're using their rules that they made to our benefit. And we're learning how to operate in accordance with the law, but yet reducing our tax bills and taking the money that we've made, and we're building up legacies for our family. And I like to believe, and my beliefs is not only am I building up a legacy for my family with the money that I've made, but I'm able to donate and to give to the kingdom of God for give the way that I decide to on the money that I've made, rather than giving it to a government to use in ideas and in ways that I may or may not agree with. So we're using what they have created to benefit us.
That's good. Claudia, I think you have some questions.
Was, that again, Ms. BB, thank you so much for breaking that down, because I think a lot of times this is all new to a lot of us and to a lot of individuals. And so this is just going to be doing things just a little bit differently. But the beautiful part about the National Trust Institute, which is being put in place, is that it is there to guide you through to make sure that you're not, if you have questions, or you can get answers to the decisions that you are making. And we're not just leaving you out there where you're hoping that you're doing the right thing. The power of being a trustee, because you don't own a trust, you're the trustee of that trust.
Absolutely.
And the power of being that trustee is that you have all the power. And so a lot of times people feel like if they don't own something, that they're losing power, they're losing control of it, but you have all the power. as a trustee of that trust. And so you're able to do all types of things as far as being able to, as Ms. Brenda was saying, determine what is considered extraordinary dividends. You're going to love that word, extraordinary dividends. I just found out about that word just a few short years ago. And I tell you, that's a beautiful word, extraordinary dividends. And so you'll be making the trust will be making extraordinary dividends that you're able to defer the taxes into perpetuity, and then also understanding how all of this works when you are making decisions on just doing simple things and being able to grow your business with the funds that are going back into the extraordinary dividends that are going back into the corpus of the trust, which allow you to grow that trust. When you think
Right.
about the Kennedys, they're on 6, if not 7 generations of their trust, taking care of their family, passing on from generation to generation. What you'll love about this trust, ladies and gentlemen, that the trust continues on. The trust does not die. The trust is an entity of its own. So even if you were to pass, you will have who your successor trustee will be, and that person will go into the bank with that document and take over the trust account, because guess what? They don't do it the same way that you do when we pass. When we pass, they shut our bank accounts down, don't they? They look at our social security numbers and boom, any social security number that's matched up with a death certificate, everything connected to that gets shut down and put into what? Probate. This trust will allow you to not have to deal with that. When you think about the people that have passed that are famous, that did not have this type of trust, that's why we say that we are the informed. That's why we say that we're the blessed, because it doesn't matter how much money you have, it's how much knowledge has been poured into you. And that's what we're here to do, is pour the knowledge into you so that you are able to navigate this trust world and be able to do all that you can do and leave a legacy that your family will be toasting to you over the dining room table on holidays when they say, Grandpa, Grandma, so-and-so sure took care of us, sure hooked us up. That's what you want. That's what you want. You want to leave a legacy for your children's children. And with that being said, we could go all day, but I want you to get back with the person.
Okay, one more question, Claudia. One more.
Okay.
I think, okay, one more. Now, I know, Ms. Brenda, you probably got another appointment. But can the money grow in the trust as an investment? And then second to that is, will the beneficiaries get an inheritance tax? If you could answer those two. And I'm sorry, I'll let everybody go.
Okay, so yes, the money can grow in the corpus of the trust if the trustee use the money that is held in corpus and invested. That there is no law against that. So speaking to that 5 million again, some of those funds, the trustee is legal to make a decision to invest that money so that he can increase the capital gains or the extraordinary dividends for the beneficiaries. So some of that money that's held in corpus can be invested to increase it. Absolutely.
Could you show that example that you shared with me with the doctor that you had, and how you moved her money around as W-2 income? So I think sometimes some people feel like, okay, they have to be an entrepreneur in order for them to be able to tap into the trust, but to actually have W-2 income, and how you did that with a particular physician that you helped, and you moved her money into a charitable. Do you mind just sharing that?
Absolutely. So there are many different strategies with the operating in the corpuses of trust. I would like to say there is not a 1, 2, 3 ABC type. What we like to best do is determine what strategy works best for a person's mission and goals in life and how they're operating. So what Jackie is speaking to is a doctor that I have currently. She's a partner with many other doctors, and currently she's getting W-2 because most of us know that if we operate inside of what's called an S corporation, an 1120 return, S corporation says that each of the owners or the shareholders must receive what's considered a reasonable income. So Because of that, the doctors that's all part equity owners in this 1120 all receive a reasonable W-2 income. But with her portion and her husband portions, because they're both married and they're doctors, they're both getting W-2 incomes. What they have done is not only do they have a beneficial trust, they have a charitable trust. And they donate their W-2 income to the charitable trust that they are trustees of. And the charitable trust has a rule that states of all of the donations that it takes in, 5% of those donations has to go out to a known cause or a cause of the trustees choosing. So what they have done for their 5% of, there's another whole strategy with the 95% that's sitting in corporates that we could talk a lot about. But for the 5% strategy, I believe this is what Jackie is speaking in tune of, that needs to go out to a known 501c3, if you would, or a known charity given to a cause that the trustee has set this charitable foundation up for, foundational trust up for. They partnered with a 501c3. They donate their 5% to the 501c3. The 501c3 invest this percentage of monies to a certain platform, and that particular platform is yielding monies for the 501c3, more money than the 5%, as well as for the doctors, because on the back end of that investment, they have a service agreement that the 501c3 will keep 80% of whatever the money yields, and the doctor and his wife will keep 20%. So it's a win-win. The donation is yielding more money for all of them, and they have created legal documents that's allowing this to happen, that not only are they adhering to the 5% donation, but they are making that 5% donation become even more for the 501c3, as well as making more for them. So it's a lot of strategies out there that we could use, or we could just tap into once we understand what are the rules and how do we work within this rule to make it work for us and in our best interest. So that's just one of the ways if you're a W-2 employee. Absolutely.
Thank you for that. Okay, I won't hold anybody up anymore.
Awesome. Guys, I think that, when you hear these different strategies, and as you get an opportunity to work with Ms. Brenda and her team, it'll amaze you, and you'll feel good about what you're doing. You'll understand. You may not understand all of it, but you'll be able to know that you're in good hands. And this is not Allstate. You're in good hands with Empower and Success and Miss BB Hills and her team, and we're excited. So what I like to do, is I know a lot of people were invited by different individuals here. If you would get back with either myself or Miss Jackie or even Miss Brenda, and let us know that you want to get a consultation to talk about your particular situation, because as she was saying, everybody's different. Everybody income is different. Most jobs and industries are different, but at the end of the day, all of it deals with taxes, and there's a place for all of it. And so within the trust, you can do anything just about with this trust. It is a living entity. So get yourself settled into a trust, become a trustee, own nothing and control everything. Because how many people know that when you own something, that's when people try to take it from you? But when they look you up and then they say, oh, shoot, what do you mean he a billionaire? He don't show he no billionaire. Ain't none of their business, right? Because you have your assets working for you, not working for them. So you control your assets, you control the trust. And so that's what it's about. I'm excited to be a part of this, be a part of the Inform Club, get back with the person that invited you. Our goal is to start having these calls on a regular basis so that you all are able to invite other people to do it. And so we'll get your schedule out to where we'll be doing this at the same bad time, same bad channel throughout the week. and be able to inform you. And again, we're looking forward to the National Trust Institute, which will be coming out here real soon. And you want to become a member of that as well to help you navigate through these trust waters. So if there's no other questions, again, I want to thank Ms. Jackie. I want to thank Ms. BB. I want to thank all of you for taking time out of your busy schedule. And with that being said, this call is officially over. Have a fantastic evening, everyone.
Good night, everybody.
Good night.
Good night. Real quick, I know you guys gonna have this again, but was this recorded? Can this be shared?
I did record it, and then let me figure all of that good stuff and getting it out.
All right, perfect. Appreciate it. We
Awesome.
got too excited about doing paperwork and stuff about the trust, and we forgot all about it.
Understood.
Thank you.
Very welcome.
Good evening.
Thank you.